In this episode, we're going to look at the process of taking journal entries from the general journal and posting them to the general ledger. Recall that a business transaction is first entered into the accounting system by creating a journal entry in the general journal. So let's assume that an owner invested cash in the business in exchange for common stock. The business transaction was identified. Now we are recording it into the accounting system. The first step is to prepare a journal entry in the accounting system. The general journal records this entry by showing what accounts are debited and what accounts are credited and the amount of the debit and credit. When an owner invests in the company in exchange for common stock, the company received cash. Cash is an asset. Cash is increasing. To increase an asset account, we need to debit it. So we create a journal entry debiting cash for the amount that needs to be debited. Then we show the account being credited. Common stock. It is increasing because the company gave the owner common stock in exchange for the cash. Common stock is an equity account. To increase common stock, we credit. The amount of the credit is $30,000. So here we're seeing a journal entry in good form. The account being debited is first, followed by the account being credited, indented, the date that the transaction occurred, the amounts that need to be recorded to change the account balances, and a little description, explanation of why this transaction is being recorded into the general journal. This is a journal entry. This journal entry in the general journal is just telling the accounting system what accounts need to be increased or decreased. It hasn't actually caused those account balances to change because the account balances are kept track of in the general ledger where all of the account records are maintained. So once we create the journal in the general journal, we need to then take each debit and credit and post it to the general ledger. Cash. General journal says we need to debit cash for $30,000. So we are going to go to the general ledger and locate the cash account. We pull out that cash file or the cash account, see that it is account number 101. The first thing to do upon locating the account in the ledger is to record the date the transaction occurred. This transaction occurred on December 1st of 2019. So in the cash account, in the general ledger, the date that this entry is being posted is December 1st. With the date recorded, we are then going to record the amount. The general journal tells us we need to debit the cash account for $30,000, so we are going to post a $30,000 debit to the cash account. We then need to record where that debit came from. This debit came from the general journal, page 1. We are going to put a little abbreviation G for general journal and the page number. This is the post reference column. This is the column that tells us where this posting reference is from. We then need to update the balance. A debit will increase a cash account. Asset cash is increased $30,000. It did have no balance because this is the first entry into this account, so it was zero. The debit increased the cash account. So after that debit was posted, cash now has a debit balance of $30,000. To finish our posting process, we need to go back to the general journal and put a post reference of where that debit was posted to in its post reference column. That debit of $30,000 was posted to account number 101 from the general ledger. Having a post reference at both locations, where the debit came from and where it went to, it easily enables us to be able to retrace and verify that the Debit was appropriately posted.